The path to financial freedom can be paved with many different bricks, and choosing the right ones depends on your goals and risk tolerance. Here are 8 powerful assets that could potentially make you wealthier in 2024. Number 1, index funds. Wealth building typically takes time, and one of the most advised ways to build your wealth is to invest for the long term. Index funds allow you to do this. They are a collection of stocks, bonds, and other assets that follow a market index. Most people have heard of the S&P 500. This is an index that houses all of the stocks of the top 500 companies in America. And if you invested into a fund that followed this index, you'd have experienced, on average, a 10% rate of return over its lifetime. Warren Buffett, one of the richest men in the world and arguably the greatest investor of our time, is a huge supporter of low-cost index funds. While they're not glamorous and the market will always have some level of volatility, income generated by index funds can be a stable increase over the long haul. 2, dividend stocks. Getting paid regularly simply for owning shares in a company, that's what dividend stocks do. Some companies provide investors with a steady stream of income in the form of monthly, quarterly, or even annual cash payouts. A dividend yield of around 3% will give you $3 every quarter for every $100 invested. This might not sound like a lot, but if you had $1 million invested, that's $30,000. And dividends aren't just about the immediate income. Over time, these dividends can snowball through reinvestment, compounding your wealth significantly. If you reinvested all your 3% dividends over 20 years, your total return would be staggering. Now, dividend stocks aren't all roses. Depending on the market, stock prices can be volatile, meaning a company could decide to pause or even cancel dividends entirely. Always do your research to choose companies or funds with strong financial and sustainable dividend policies. Now, if dividends aren't appealing to you, you can own brick and mortar, which has been a classic wealth-building strategy for centuries, and for good reason. Number 3, real estate. Real estate often appreciates in value over the long term, offering potential for significant capital gains in the future. For instance, the average U.S. home price has grown by over 6% annually since 1980. This is why home ownership is often prioritized, but be careful. If you buy too much house, you may be forced to sell before you're ready. Real estate can also generate passive income through rental payments. A rental property can become a silent partner, adding to your bank account every month. Additionally, you can enjoy tax benefits like depreciation deductions that can lower your taxable income. Of course, the entry point can be quite high. A down payment and closing costs can be hefty, and ongoing expenses like maintenance and repairs are inevitable and must be planned for, costing even more. Even the act of selling real estate takes time and isn't as quick and easy as potentially buying bonds. Number 4, bonds. If you crave peace of mind in your investments, bonds might be your cup of tea. Unlike stocks, bonds offer fixed interest payments at regular intervals, providing a predictable income stream. Bonds are lending money to a government or company and receiving regular interest payments in return. A 10-year U.S. Treasury bond might offer a 2% annual interest rate, guaranteeing you $200 for every $10,000 invested each year. Stability around bonds comes with lower risk compared to stocks. Bondholders are typically paid before shareholders in case of a company's downfall, offering some protection against financial downtime. Additionally, certain types of bonds can even shield you from inflation. But the trade-off for stability is often lower potential returns. Compared to the growth potential of stocks, index funds, or even real estate, bonds usually offer a tamer ride. Plus, rising interest rates can actually lead to the value of your existing bonds falling, potentially causing losses if you sell before maturity. Part of the reason you have lower returns with bonds is the financial structures to obtain such bonds. But you can cut out the middleman. You could become your own lender. Number 5, peer-to-peer lending. You work directly with borrowers looking for personal loans, car loans, or even small business financing. You choose who to lend to based on their creditworthiness and set your desired interest rate, earning returns directly from individuals instead of through faceless institutions. With this, you can ditch the measly savings account interest rates and earn as high as 7 to 10% on average, significantly outpacing traditional options. Plus, you can spread your loans across diverse borrowers and industries, mitigating risk and maximizing your earning potential. Much like real estate though, entry into this asset class can be high, and you have to be careful. Not everyone repays their loans. Also, selling your loan before maturity can be inconvenient and involve penalties since it's not as liquid as cash in your bank account and interest income is taxable. Number 6, Commodities. Investing in commodities allows you to invest in the very essence of our modern world: oil, copper, gold, and more. The prices of these commodities can fluctuate wildly, but their unique relationship with inflation and global markets makes them a valuable addition to a well-rounded portfolio. When the cost of living rises, so can the price of commodities, effectively protecting your purchasing power, serving as an inflation hedge. Commodities add a unique and often counter-cyclical asset class to your portfolio, reducing overall risk and smoothing out bumpy market rides. Prices can experience significant swings, offering opportunities for quick gains, although volatility also brings the risk of sharp losses. Some commodities require specialized knowledge and trading platforms, not readily available to all investors. So again, do your research before diving in head first. There is one asset that is available for everyone, though. Number 7, business ownership. Business ownership can be a challenging but potentially immensely rewarding path to wealth creation. From innovative tech startups to charming local cafes and restaurants, the possibilities are enormous. You become the master of your own finance, building something from the ground up and potentially reaping the financial fruits of your vision and hustle. If your business takes off, the sky's the limit on your profits. Building such a successful empire can significantly boost your net worth. You get to enjoy tax advantages like deduction for expenses and depreciation, potentially reducing your overall tax burden. But the statistics are harsh. Many businesses fail within their first few years, so be prepared for long hours, hard work, and the possibility of seeing your investment go up in smoke. And depending on the business type, getting started can require significant capital and resources. But if you're able to push through that, you get to enjoy a unique satisfaction in building something from scratch, watching your idea come to life and making a mark on the world. 8. Yourself. You are your greatest asset, and the opportunity to make more money will always be with you, so bet on yourself. Generating income is directly correlated with the kind of problems you can solve and how much value you provide. So what can you do? Well, most people will immediately think about going back to school for future education, but there are so many ways to increase learning. You can attend workshops, seminars, or even watch videos on YouTube. You are an asset of one with unlimited potential, so use your time, energy, and labor wisely. Build your skills and grow your net worth. Diversification is key. Remember the dot-com bubble? Inflated tech stocks were pushed to incredible heights, and many investors piled into these, hoping for skyrocketing returns. But the bubble burst in 2000 and led to devastating losses for those who weren't diversified. In contrast, investors with a balanced portfolio of tech stocks alongside less volatile assets like utilities or consumer staples weathered the storm, and some even saw modest gains while the tech sector corrected. Think of the devastating crash of 2008. The S&P 500, a benchmark for US stocks, plummeted by over 50%. If your entire portfolio was invested in stocks during that period, the pain would have been immense. Conversely, an investor with a diversified portfolio, including bonds and other less volatile assets, would have experienced a smaller blow, providing a buffer against the market's turmoil. The point is, diversification doesn't guarantee riches, but it significantly reduces your risk of major losses and provides a smoother, more sustainable path to wealth creation. Think of it as building a financial bridge with multiple pillars. Each asset class contributes to its stability and ensures it can withstand even the strongest storms. Like we said earlier, there are different paths to building wealth. The best path for you depends on your unique financial goals and risk tolerance. Assets like index funds and dividend stocks offer passive income and long-term growth potential, but require careful research. Real estate provides tangible value and rental income, but comes with a high entry point and less liquidity. Bonds offer stability and predictability, but at the cost of lower potential returns. So whether you're a risk taker seeking a venture and big returns, a strategic investor looking for diversification, or a budding entrepreneur with a fire mentality, we're sure one or more of these assets can be immeasurable for you. Just don't forget to do your research. Thanks so much for watching. If you enjoyed the video, please like and subscribe, and we'll see you in the next one.